Good afternoon, Henry Wheelwright, Stablepoint Partners checking in. It's Friday, February 27th. Want to welcome our clients and guests. Those that are in the Boston area, hopefully you made it through the storm. Some lost power, a lot of shoveling. I will tell you it's been the return of the New England winter. But let's just jump into what's happening in the markets. 2026 has been a fast-moving and a rapid rotation year. It's sitting here now 2 months in. I think the big story has really been the separation of last year's AI, hyperscalers, big software company winners, the Magnificent Seven that have driven the S&P to all-time highs. Now we're seeing underperformance in those markets. We're seeing heightened levels of volatility. And there's some real questions about the potential disruption in the service as a subscription, SaaS, what is being called the AI apocalypse. So let's break down where we're at. I mean, we're approaching now 6 out of 7 negative weeks in the NASDAQ, of course, a tech-heavy index driven by wonderful companies like NVIDIA, which reported. We've seen the single stock versus the S&P 500 volatility, the volatility between individual companies that make up that index, and the volatility within the S&P 500 itself at its widest margin. We have huge return dispersions within the sectors. One of the charts that I'll bring up, we're talking about the revenge of the old economy. The old economy sectors like energy sit at the top, up almost 25%. Materials, industrials, we look at a return in home builders. A lot of those real asset, hard asset, infrastructure style businesses that produce free cash flow that lagged the market last year and quite frankly have lagged the last 4 to 5 years have really come out and produced very strong returns for our dividend clients and value clients. Our dividend growth portfolio has done exceptionally well. So let's talk about what's going on really behind the scenes with AI and AI in general being a potential disruptor. The first, and I'll bring up a chart, this is from our friends and partners at Goldman Sachs. We put a lot of time into thinking about the reality of where we are and potentially one of the most disruptive and more advanced pieces of technologies that we've seen ever. Number one is software in the long and short is not going to be dead. However, there's really going to be a separation of winners and losers going forward. We've seen that already this year in the market. Areas in the semiconductor sector have done very well. But we've also seen muted responses because expectations have been so strong. NVIDIA posted what I thought was a stellar earnings report earlier this week, failed to rally and actually finished the day down, I believe down about 3 or 4% with amazing revenue growth, particularly around data centers. We've heard from all the large hyperscalers about spending. I think this is really a story about in the next few years, or if not year itself, we're going to get a sense on where the barriers for entries are and where the moats are as it relates to AI. The AI craze and sell-off really was started by a number of factors. Those that are familiar with Anthropic, a private company much like OpenAI that competes for AI agents and co-pilots that help you perform various tasks, has released a number of pieces of software. Claude, Anthropic's, has produced some rather significant and amazing results. And we saw these impacts really hurting a number of highly valued growth names that had run up a lot. So what's the Stablepoint story, and I think the takeaway for our clients? Number one is this is probably more about heightened valuations and the concentration that we've been talking about for years to clients. 10 companies made up 40% of the US S&P 500, and as a result, those 10 companies have been large, predominantly software hyperscalers. When they have doubt in their valuations and doubt in their ability to grow, you're going to have some underperforming index returns. So it's about owning individual equities, paying attention to valuations. Number two is change is happening. Our job as a fiduciary and leader is to be in front of that change, leveraging research, thinking about businesses that may have some barriers. What industries can work alongside AI, where compliance might be an area that is heavy and makes it very difficult to be replaced by artificial intelligence in general. We feel that way about cybersecurity stocks that were sold off significantly. We also want to look at data intensive or user-intensive models that could be replaced, service industries that rely heavily on frontline sales forces, not on back-end infrastructure that's really part of the end value proposition. Those potentially could be at risk. As I've said to many clients, I don't look at this last couple weeks as an indication that you should sell software, but it's a great opportunity to look at your portfolio, establish whether you have the right allocation, and think more about that stock, bond, cash, other private market mix. The other big story that really is correlated a bit has been lending. A lot of news around private credit. You know, our feelings in the alt space, not all lending is equal. I've really urged a lot of clients to think and look under the hood. We're not actually seeing defaults in the private credit space. We had a company, Blue Owl, that essentially has limited liquidity, has pointed out some of their software loans as being less liquid. When you actually look at the private credit space, defaults have been not happening in any significant manner, but it is leading to this overall rotation to a defensive market. So look at what's been winning this year. Dividend value names, consumer staples, energy, industrials, healthcare to some extent. Non-US equities, where the index is less concentrated around big software companies, developed Europe, emerging markets, international in general has outperformed. And I think when you really look underneath the growth elements, and our growth portfolio has outperformed markets this year, it's literally just looking at growth companies that are properly positioned to not be displaced from AI. So big story. I always say it, there's a lot of noise, a lot of excitement every week. We remain very bullish on the market, positive for clients that are properly diversified, and appreciate the trust and confidence. The AI apocalypse is a little scary, but I don't think it's here to ruin the party. Take care now. Have a great weekend.